Hey everyone! Unblocked is a bi-monthly event series where guests are asked questions in an AMA-style format, focusing on questions relevant to early-stage startups and blockchain technology. Unblocked is sponsored by DLab, a startup accelerator and venture studio that sits within the SOSV family. You can find out more at www.dlab.vc. We hope you enjoy the conversation. What is Cadence? So why don't you tell the audience, like you're the CEO of Cadence, what's its mission?
Sure,
What are you guys trying to do?
absolutely. So I would say the easiest way to think about it at the highest level is that we're building the Bloomberg of private capital markets. And so Bloomberg, for anyone who doesn't know, is a market data vendor. And so they essentially have built a business off of standardizing, normalizing, and making very efficient the ability to capture data, interpret data, analyze data coming out of the public markets. And so there's not really a ton of people that are focused on the private side. And so our job is to really kind of create that underlying data set for private markets to be able to actually create more efficient private capital markets. So to do that, we have to kind of start a little bit smaller. So we got to focus on one specific asset class within private capital markets. And we chose debt, so private debt. And then at this point right now, if you were to go on our website, it just looks like we have a investment platform for private debt, essentially. What that does is kind of tee up our future, where we have the ability to actually help um, offer a service or a solution or a software for every single stage of a private debt lender's growth. And so these are oftentimes VC-backed companies, and I always like to think that I'm a VC portfolio company's best friend, and so I'm a VC's best friend inherently, because we have the ability to actually help them get the capital they need to get to that next level of their growth, to the point where they're ready for banks to step in and help them get the cheapest cost of capital they can get elsewhere as a lender. And so from there, once we kind of conquer private debt, we can go into other asset classes within private capital markets.
And so, like, would you say that your ideal customer, at least on the supply side, is like early stage startups, later stage startups, or just the whole spectrum?
Yeah, for sure. So later stage startup is probably too late for us at that point unless we knew them earlier, right? So if you think about companies that you may recognize, Cabbage, Lending Club, Prosper, Bluevine, those guys, right? Those are all
Mhm.
kind of came from the VC backed world, were darlings at some point in time. And so they struggled at the early stages with getting capital. As they got bigger and bigger, people got more and more interested. Banks got more and more interested. And so when you're so late stage, you have the cheapest cost of capital you can get anywhere. Banks will step in and help you source the capital or provide it off their own balance sheet. When you're an early stage company, so think Cabbage 5, 6 years ago, they were probably asking like random investors who are high net worth people to give them money so they can start lending it out on their books. And so our website right now, our investment platform there helps them at that stage get to what they need to grow to be able to get to the next stage and the next stage until they become what Cabbage is today, basically.
And so, like, what is like the scenario? Because like traditionally, how fundraising goes for, I guess, early stage, mid stage startups is that they raise from traditional venture capital investors.
Hmm.
So, what is the, I guess, like, what is the scenario that you envision a startup coming to your platform? Is it where they're looking for a bridge round and they can't really, they need
Sure.
to close capital quickly, or
Yeah.
what's the scenario you envision?
That's a great distinction. So we actually don't ever raise equity capital for them. So the interesting part is this is what VCs would hate to see actually happen, but startups do it anyway. Is that they use their own VC equity to actually make loans, right? So these are primarily lenders. And so if you use that, that is the highest risk, most expensive capital you can get, right? Because if basically if that loan defaults, then you're actually out VC's money, which is terrible. And so we provide and source capital from various different alternative accredited investors to be able to give them lending capital to be able to actually lend out to whatever ultimate borrower they're focused on, whether it's a small business, a consumer, or whatever it is. And so they can keep the VC side for actually running the business, and they have a pool of capital they can use to be able to actually for lending.
Yeah, that's cool. And so, how long is like a loan? Is it a 10-year loan, 5-year loans? Is it
Great
any way you
question.
want to slice
So
it?
the underlying lender has different durations based on what they think is worthwhile for the risk. And so some of them may be very short durations. So we're talking like, if we have Colombian and Mexico consumer loans, those are in the range of like less than 1 month, right? But then you have small business lending in the United States that could be, a year, could be a year and a half. So it really is at the discretion of the lender. what we've done is create what we like to call a short-term note program. So effectively, it helps everyone get happy as a result. So on the investor side, they get to invest in short duration products like 1 month, 3 month investments. It's at a good yield. And so pre-COVID, it was like 8 to 12% ish. Post COVID, it's pushing like, I would say 12 to 19%. So
Wow.
that's the environment that we're in right now. And they're willing to take that capital if they can't get anywhere else. But then from the originator side, they have different types of debt that they can use for different purposes. So for a 1 month note that we give them or debt instrument that we give them, that can account for peaks and valleys in their growth, right? So certain months are really, really good. They need more money. Certain months are not as good. And so they can kind of adjust that as they see fit. We give them 3 month debt instruments. That, in that case, allows them to account for cyclicality around quarters and seasonality. And so certain companies do very well in the winter, poorly in the summer, vice versa. And so that all comes into play. And then we have 6 month, 9 month longer dated stuff that's just more in line with sort of the actual length of the loan itself. So it's this type of flexibility that's great for the originator. It's also great for the investor because they get inherent liquidity with a 1 month product yielding, anywhere from
Mm.
12 to 19%. That's not too bad.
No, that's great. And so, so you have some users using it today, correct?
Hmm. Yep.
And like,
Yeah.
how long ago did you start?
So we founded the company in called June of 2018 ish. So we're pushing 2 years now at this point. It's been I think a very quick 2 years, all things considered. And so we spent the first 6 months of the year building out a legal framework that lets us do these types of short duration investment debt offerings at scale. And then we launched in private beta in January of last year, which was fine. It was like 30 users throwing some money around, which is totally
Mhm.
kind of how it's supposed to be done. And then we launched, went live and went publicly with it in July of last year. And we actually just crossed $100 million in total issuance on the retail side a
Mhm.
couple weeks ago. So it's been a pretty good couple months.
Wow, that's great. That's congratulations. Um, and so who are like, so that's on the supply side in terms of, well, I guess supply side in terms of the companies that are looking for loans, but who are the people on the quote unquote, I guess, buy side? Are they
Yeah,
typically
sure.
like like, are they angels or are they, smaller private equity funds or funds
Uh,
generally?
Good question. So, on the retail side, it's a lot of doctors, lawyers, bankers who kind of
Okay.
Google this stuff on a regular basis on the weekends because they think it's
Yeah.
fun to do. And
Yeah.
so they're the ones who tend to be accredited. They're the ones who can drop, $25,000 at a time on an investment.
Yeah.
And so that seems to be the best audience there. But as these deals get bigger and bigger, because generally a lot of these supply side, lenders, they are providing, we're giving them $5 million, $10 million. You can kind of fulfill that pretty easily with a retail investor base. When they graduate and they grow up, we bring them to the institutional markets where they need 40, 50, $60 million. And you need a lot of doctors, lawyers, and bankers to get to that level
Yep.
at scale. And so that's really where we engage the credit funds, the pension funds, if it's an insurance companies, if it's a rated deal, I can go a lot of different directions. And so, like I said, we have a solution or service or software for every single
Mhm.
phase of this supply side's growth.
That's cool. And so what would you say, um, like what's been created in the present time where it's allowed a company like Cadence to be created, where maybe 10 years ago, maybe 5 years ago, there wasn't that opportunity? Has it
Yeah,
been a change in
great question.
regulation? Has it been advancement in technology? Um, would love to hear your thoughts.
Definitely on the advancement technology front. So a lot of what happened in 08, 09 was a result of a lack of actual data around what is actually going on with the underlying assets and how they're performing. And so
Mhm.
in this instance, there's like a fintech company for every single potential solution you want to solve for, right? So if I need KYC, if I need to pull money, if I need to, check a bank account, like there's something there for everybody, right? But no one has actually aggregated all together to be able to actually leverage that to create an underlying, call it master data set for all of private capital markets. And we're starting obviously with private debt. And so the ability for us to provide this transparency into how private debt assets are performing is how we kind of get to that next phase of the business that we want to get to. And so it's piggybacking off of the success and the rise of all these underlying fintech companies that are providing the pipes to make all this stuff work. And that we simply sit on top of that to be able to kind of piecemeal it all together in a way that makes it all work for the specific market that we're going after.
Mm. And so, like, is this your first startup?
The first legitimate startup, I guess you want to call it. I've kind of been around the block for a little bit. I was in finance for a very short 3 years of my life when I first got started after I graduated college. Hated my life, so I was like, okay, when you hate your life, you try and do something else and do your own thing. I thought I could do a startup at that point in time. I failed miserably, and so when you're broke
Mhm.
and you ran out of money and you burn through all your savings, you become a consultant. And so I became a consultant, launched my own strategy consulting company, helping startups actually in the fintech side of things. And so in that time frame, I was also able to get connected with a lot of VCs, to connect them and introduce them to the clients that we work with. We were very selective about which clients that we ended up choosing. They had to have been usually a founder that had exited a company before, and it also had to have been an idea that we actually would personally be interested in investing in. Only if those two criteria were met would we actually want to work with them. And so it narrows the list down substantially.
Mhm.
So that was fine. Did that for about 6 years, had some good case studies and wins coming out of that. And then realized that if I'm telling and advising all these founders as to what to do, and I have an entire team that can help build product, I should just do it myself. So for the right idea, the right time, I figured I would jump ship and do it all over again. So yeah.
Yeah. And so what would you say, what would you say you learned? What were the learning experiences from the quote unquote failed startup? And would you say it's like you learned more from that experience, and helped you build the cadence and helped you build it in a way where you learn from those types of mistakes?
Yeah, so I think I feel very fortunate that every single phase of my career, per se, over the last, how long has it been? I guess 10 years, the last 10 years has been leading me up to this point, right? So, having a finance background, having a corporate background, I do encourage everyone to at least try and go through corporate at least once in their life. It hardens you, it teaches you all the things that you don't want and you don't like. And so once you've kind of had that bitter taste in your mouth, you know exactly what not to do when you have your own company. So highly encourage that. But it also teaches you a level of perfectionism and accuracy and attention to detail that you don't really get. You just have been in startups your whole life. So that helped me be able to kind of hone my skill set very early on in my career. And then when I was doing a failed startup, I picked up everything else, right? So as a single founder of a single person company, you have to be the designer, you have to be the semi developer, or at least the product manager, you have to be the BD guy, you have to be the fundraiser. And so I picked up all these skills that allowed me to get to the point where a consulting company would have legs effectively, because otherwise who would want to hire me? And so at the consulting company, my finance background helped penetrate a lot of fintech companies because they valued the insight that I had, having come from Bank of America, from BlackRock, and things like that. And so that allowed me to get in with those guys and do a good job with them, but also leveraging the design, the development, and all that experience that I had in my failed startup to be able to actually piggyback off of, how do I hire the right designer? How do I hire the right developers to be able to now do all this stuff? So all of that together was really powerful, and so it led me towards building up a relationship with the family office at that point in time. So as I said, I got connected to a lot of VCs, but also family offices, and he wanted me to advise him on investing in companies. So I have a great portfolio pipeline of very early stage companies that he can get first look into, and he did invest in a few of our clients. But that opened up a network of the rest of the VCs, and so whenever you have money, people always come to you. Other VCs come to you because they also think they need money too. And then you also have startups that come to you. So that allowed me to build up that network. And that was the first group I went to for Cadence when we need to
Yeah.
raise money. And so, again, I think I've been very, very fortunate in my career path. But I've also tried to keep every door open because you never know what's going to be behind it, usually for the better. And so that allowed me to get to where I am today. But I feel very fortunate that these opportunities and these doors have been presented to me to begin with.
Yeah, no, that makes complete sense. Also wanted to note to everybody in the crowd that if you wanted to ask a question, just please dump it in the Q&A, and I'll be happy to ask it at the end of the session. But you spoke a lot about sort of building relationships. So what is some advice you would give to those who are trying to grow their network? How do you nourish those relationships? Do you check in with them? Any tips?
Yeah, great question. So I would say associates, and when it comes to fundraising, at least, the
Mhm.
associates at a fund are actually very powerful because they're the ones that are more likely to take meetings. Their job is to basically scour the entire market, and so they're not going to be the ones that ultimately decide for you, and they don't have as much pull as you probably like. But they're the ones who can help you at least get that first meeting with a partner, and then it's on you from there to nurture and nourish that relationship, right? So, as part of the fundraising process, as a CEO, as a founder, your job is to keep everyone in the loop at all times, basically, right? So as we're going out for Cadence for the first round of financing on the pre-seed side, and then after later on the seed stage side, we do two things on a very recurring basis. First and foremost, we actually have to keep our existing investors very happy. And so we do send monthly investor updates that are very detailed, very thorough. And so it presents a situation where the existing VCs and investors who have invested in you have a full understanding of what's going on, right? And so they don't actually even need your help when you come back to them and say, "I'm doing a new round of financing. I have a term sheet. Do you want in or not?" You don't have to take a meeting with them. You don't have to tell them everything that's been good and hide all the bad. You basically they know, right? They know the good and the bad as a result of that. And so we've gotten tremendously positive feedback by putting in that effort to be able to do that. On the flip side, for investors who you'd like to have come on board, we have now, I send out actually usually like monthly, if not every 2 months, business updates with them, right? So key major milestones that you've hit. And so my list of like emails for that prospective VC list who are going to be needed for the next future rounds of financing are in like the 300, 400 range at this point. So it goes out to everybody that I've ever met with on the VC side because you never know. And so we've gotten good feedback from that. I've had people who have been on that list check, and it's on HubSpot. I can see if they opened it or not. They come back and they actually ultimately invest in the company. So it's doing these types of things that help a lot with terms of just staying top of mind with these guys. On the investor fronts, they see hundreds of deals a year, right? If not hundreds of deals a month. And so how do you stay on top of that? It's effort, it's work. But it definitely pays off in the long run to be able to actually help them be aware of what's going on with your side, and they ultimately feel more confident about what you're doing.
Yeah, no, that makes a lot of sense. I mean, do you feel like we tell a lot of our startups, always ask for advice, and
Yeah,
then you'll get money instead of asking for money, and
right,
then you'll get advice on the other
right.
hand? Do you feel that, at least in your experience, that adage is true?
Yeah, for sure. I think there is so much more to managing investor relationships than that pitch session, right? So take the time to get to know them. Take the time; they're people too, right? They're actually also startups for all intents and purposes. They have to raise money just like you do, and so they're in the same camp. They can relate. At the same time, spend time with them to grab coffee, and just don't always have an agenda, right? Like you should actually just offer to catch them up on what's been going on and just say I'm not looking for money, because they actually do appreciate that. And so it's so much about relationship building in this instance, so that you can get to the point where they actually can cut you a check. But it's a sometimes years long process to be able to get to that point.
Yeah, no, that makes sense. And so, like focusing more on like the growth of Cadence, are you a solo founder with Cadence as well this time around?
Yes, yeah, yep.
And like, how many people work at Cadence today?
So we have 19 today. And it's been, we had grand aspirations pre-COVID as to
Yeah.
where the headcount would be at this point in time. But at this stage, we're holding pretty tight on what we are doing on the headcount side of things, the hiring side of things. We are still growing the team, but it is much more measured approach as we start to see how the
Yeah.
market shakes out.
And I guess this is a good segue into how COVID is affecting your business. I mean, you've already alluded to that the interest rates, at least for people coming to your program platform, have gone up, which indicates the higher level of, I guess, risk or
Yeah,
compensation investors
or
are looking
reward.
for.
Yeah,
Yeah, a
exactly.
risk or a reward, but the cost of the startups, at least on your
Hmm.
platform, has gone up. So that's kind of affected that side of the business. But how about you and Cadence individually? Is it
Yeah,
sort of
absolutely.
business as usual, or?
Yeah, there's a lot to unpack there.
Yeah, yeah.
So I would say, we are in a pretty unique spot, right? So our job is to be a market maker, leveraging our data and our technology to make it all more efficient. And so whether it's a expensive deal or a cheap deal or a good deal or a bad deal, as long as there is someone willing to sell and someone looking to buy, we can do well in that environment, right? So we're actually kind of in a sheltered ecosystem here in order to make all this work. And so I feel fortunate that this is the business that we're in, and we're not, dealing with the fallout from travel, leisure, hospitality, and things like
Yeah.
that. Um, but we've seen obviously demand drop naturally from when the market crashed in March, right? And so
Mhm.
every day was like withdrawals, withdrawals, withdrawals. But I think we're the only platform that allowed investors to withdraw whatever they wanted whenever it was ready, right? So it's a testament to our ability to kind of maintain a user experience that's trustworthy, and it means a lot, right? There's a lot of platforms that just cut withdrawals, saying we need to hold it, can't do it right now, and this is people's hard-earned money. They're going to freak out when you do something like that. And so
Yeah.
we stayed true to our own mantra around that. And they rewarded us with, bringing the money back in after things have settled down a little bit. So obviously the equity markets right now are completely dislocated from reality, but that's okay.
Yeah.
So they are coming back, and that gives people more comfort in investing in our stuff. My Our thinking throughout this process was everybody has price, right? So for the right price, you will come back in because you feel like it's commensurate with the risk that you're taking in this environment. And so that's
Mhm.
the reason why the yields have gone up so much. So we were the only ones that were able to reprice these products because our stuff is so short. So we had a bunch of deals that were maturing and rolling over into the next, 1 month, 3 month cycle that we were able to actually give more yield as a result.
Mhm.
So in this environment, the best thing you can do for high quality lenders is to continue to give them capital. In this environment, they are good underwriters. They can reprice, they can reassess the risk on their side, and we've seen it with the data coming through. We track everything, right? So we've had lenders whose post-COVID vintage is performing at 98%, when in prior to COVID they were performing at 95%. So they're even doing
Mhm.
better now than they were before, and that's helping to basically rebalance their portfolio for the better. So
Mhm.
yeah, so we've seen flows stabilize. We are on, I think, a 6-day win streak of net positive flows, which is great
That's
to
great.
see.
Yeah.
And we also have additional deals coming through on the bigger side, institutional side, because everyone needs capital nowadays. But the truth is, on the lender front, even though our cost of capital for them is going up because our yields have
Mhm.
gone to 12 to 19%, the yields that they're getting from borrowers are also going up. So they just naturally have like a buffer, right? So what was originally 12, 8 is now 12, which means that what they're selling to borrowers is now like 16, for example. So really it's just a sliding scale, and it's kind of reacting to the environment that we're in.
No, that makes sense, and it seems like you're weathering the storm well. One question that comes to mind, because a lot of our own founders are building sort of platform companies,
Hmm.
and you always have this classic problem where you need to build both sides of demand. You need to
Sure.
build supply, and you need to buy the buy side. So, what advice would you give to those who are looking to create a platform? Because you need to get sellers to come to your platform,
Yep.
and you need to get buyers to come to your platform. So,
Yeah.
do you have any advice to those individuals as to how to achieve that?
Yeah, for sure. I think the so I can use our story as an anecdote, and then we can kind of extrapolate out from there. But basically, we went after a market that was very saturated, right? So it was basically alternative investments that covers, if you guys have heard of it, Yield Street, Peer Street, Fundrise, Ground Floor, like anything and everything under the sun. In this kind of boom economy for the last, call it 5 years, has led to these guys doing all very well. Crowdfunding, if you will, right? So you can guarantee that you can be successful in a space that's very crowded by having the sexiest mousetrap, basically. And so those guys all had high minimums. So it was like $5,000, $10,000, $15,000 to invest in a product, which for a rando startup that's starting out, that doesn't make any sense. I would never trust you with my money. And so we dropped our minimums to $500, right? So it's the lowest minimum anywhere. You could just try it for $500. Worst case, if we're a total scam, is you're out $500. Basically, you're not out 15 grand. We knew based on research that people inherently want liquidity, right? So like, I don't trust these startups who may go bankrupt in a year. Like, how do I get my money back? And so to be able to provide short duration, ultra short duration investments, 2 weeks, 1 month, 3 months, people have comfort that they can know their cash position at that point in time. And then at the same time, there's also pricing, right? So as long as your yields are competitive with everybody else, as long as you are cheaper than everybody else, then you'll be successful. And so if you compare a product side by side, there is zero reason why you invest in something else, essentially. And so it's kind of like the Uber Lyft scenario where people are completely agnostic. I don't care if they're agnostic as to which one they choose, as long as it's a cheaper price because the cars are exactly the same. In this instance, everyone's offering the same stuff, so I'm going to offer better stuff, and then you can get buy side at least with that product. On the sell side, or the other side of the market, you need to convince people to join, right? So this is going to be, you have to pull hard on your network. You have to have someone who believes in you on that side of things. And so we were fortunate, obviously we came from finance, so we had a lot of connections with that space that we're in, but I would encourage you to go after a market that you tend to know well anyway. Otherwise it's a little bit difficult to go after. Even VCs will have a hard time trusting you with that. And so if you're going after a market that you at least somewhat know well, you should be able to have the network and the connections to have someone take a flyer on you and believe in you and bet on it. And so really it's a matter of getting enough buy side demand generally to convince someone just to partner with you and sell something. So to get buy side demand, you can either guarantee it in the way that we did it, which was offering something far better than anybody else, or you can essentially, offer them something that is significantly smaller or a piece of the larger puzzle that you're trying to solve for, show that you have that demand, and convince the seller that you have more than what you're showing right now, basically. But it is a bit of a hustle, right? Like you need to be able to balance out both sides, and each side needs to think you're bigger on the other side than what they have right now to be able to believe you. So it's a nice little juggling, balancing act.
Yeah, 100%. I guess with the last question, I would be remiss to ask, since I work in the blockchain space.
Sure.
But could you talk a little bit about the blockchain implementation?
Yeah. Absolutely. So it is probably the least blockchain company out there. So I'm going to give that preface. But it is one that I think has a lot of potential for future adoption, right? So our blockchain manifests itself in two ways, not really all full blockchain. The easiest one to recognize is what we do when it comes to every security that we create, right? So we create a token or a digital asset that reflects the cap table of every single person who invests in that specific deal. So let's say, well, you've done like 95, 98 different deals at this point, right? So we have 98 different tokens on Etherscan that you can find that show you the cap table of everyone who's invested and how much they've invested for. So you can see if I'm a $500 investor, when the deal is done, I can go into that token, I can see the cap table, I click into the person who invested 1.5 million, and I can see that that person has invested 25 times the cadence. So it's supposed to be a pretty good investment, all things considered, if that person's doing it. So we have that. And that's a future that we're building towards. There's a lot more to that. On the flip side, we also have our data, right? So our data is the most important thing that we do. And so that is being recorded to an immutable ledger. So it's not actually a blockchain. It's simply just immutable. It's taking what I would argue the most important part of blockchain, which is the fact that it can't be changed. And we're taking that and recording the data so that that holds value in the future. So as we do bigger and bigger deals, people need to trust the data is accurate. So if a lender gives us data or we pull data and then it gets restated at some point in the future, I physically can't change that old data, right? So as I see restatements happen in perpetuity, it's up to me as a arranger of these deals or as a ratings agency to come in and say, I don't trust this person because they keep changing their data. And so there is a future here where we can connect those two worlds, right? So we have the ability to say, look, I know who owns this right now, and I know that I can trade this product, but how do I price this product? And the best way to price the product to see what the bid and ask should be is if you have performance data. And so you combine those two together, now you can create a primary market around these products where people buy into it for the first time. And you can create a secondary market around trading it because there's actually demand, because you can actually know what it's worth today. If 50% of the portfolio defaulted, you probably should only pay 50% of the price. And so that level of transparency doesn't exist anywhere in private markets today. And we can help make that possible. And there is elements of blockchain that are going to be very important for that in making it much more efficient as a result.
Yeah, no, I don't disagree. Even in private markets, public markets, finding performance data is almost close to impossible. Like if you wanted to look at the performance of the S&P 500 versus gold, for example, you need a Bloomberg, which is crazy.
Yeah, exactly.
Anyway, so it's wild how even though all this data is there, it's just not an easy way to access it.
Yep.
But to be clear on your blockchain implementation, like if I'm an investor and I go on a platform, I'm not holding a token. I don't need a wallet. It's just read only, right?
It's read only, and it's you can engage with it as much or as little as you want, right? So
Mhm.
that's essentially we want to get the highest level of adoption possible because no one needs
Yeah.
to actually adopt it if they don't want to. So that has made it really good. Although I will say what we did differently was we did our first big ticket deal, the institutional deal, in March, early March. It was a $40 million deal, and so that was the first time ever that a rated deal from a ratings agency was had a digital security issued for that. And so if you go on Etherscan right now, you type in FAT because it's Fat Brands for Fat Burger, FAT 2020, I think you can find the two securities we issued as a result of that, and all the corresponding cash flows that came out of that. Because we also have our own cash stablecoin. So it's a mirrored transaction, but you can, for the very first time, see how many investors invested in a traditionally very private deal. You can see how the money is shifting from the issuer, which is Fat Brands, to the six other counterparties in the transaction, because you can follow the cash, and then ultimately to the investor and vice versa. And so this is the first time that level of transparency is displayed anywhere. And again, this will be a foundation for the future that we can build on top of for everything else we want to do for the bigger ticket deals that we're doing.
No, that's great. So we're going to move into the Q&A. If anybody has
Sure.
any questions, please dump them into the Q&A. But the first question is from Sergio. He asked, "What advice do you have for pivoting career non-finance into fintech?"
Yeah, that's a great question. I would say don't be afraid of fintech. I think fintech is so broad nowadays that there is a fintech company for everybody. I would say, based on regardless of what career you came from, right? So we've seen people that are looking to offer new investment apps, right? Like Robinhoods of the world and Stashes and all that. And there is, if you have a marketing background in being able to sell D2C products, for example, they need the help, right? Like they need to figure out more interesting, unique ways to market to that audience because it is the same millennial audience that someone who would be wanting to buy D2C products. And so I would say fintech companies, everything that you touch is technically fintech. Anytime you spend money, it's fintech. And so don't be afraid of your existing career, even if it's non-finance, that it's not actually in fintech. Or financial services. And we actually oftentimes, especially when it comes to the risk oriented roles, which have to be from finance, we tend to want to hire and like to hire outside of finance because they have a different perspective. Like it actually,
Yeah.
it's refreshing. It's different. It's something that can add value because our entire culture and our team is built up based upon the collective experiences of everyone who's on board and what they've done in the past. And so if we can have a fresh look at what we're doing, it tends to be a lot better. And so I'm not the only company and the CEO that looks that way. And so I would definitely not be afraid of pivoting a career that's non-finance into fintech because there is plenty of people looking for that.
Yeah, and you need to understand your customer. And even if you're a
Yeah,
fintech customer, your customer is not going to come from finance,
correct.
and you're going to need to understand that individual or
Yeah,
individuals.
exactly.
Um, the next question is, at Cadence, did you know early on what your product market fit was, and has it changed since launch? Any advice for startups on best practices for how to navigate the product fit journey?
Yeah. So it will always change. So I had a inkling of product market fit, as I mentioned earlier, because I borrowed it from somebody else, right? So all these other companies have proven, like when Uber came out, Lyft was like, well, clearly there's a market there. Clearly someone wants it. I'm just gonna step right in there and charge less money, and then be off to the races. So we borrowed someone else's product market fit at the outset, and then as we dug deeper and deeper into it, we realized how broken this entire industry was, and we built out a completely new thesis around what our company was going to become. But we wouldn't have known that had we done it the first time with that first vision of the company, right? So the product market fit is going to perpetually change as you evolve the company, as you learn more. What I do encourage you is to not put your blinders on and say that this is it, right? I'm dead set that this is the thing, because oftentimes, actually most times, you will be wrong, and you need to. The good companies that survive and thrive are the ones who can see it and react to it, and then take advantage of it and capitalize on it when everyone else is sitting on their hands thinking that they've got the thing, right? And so it's a marathon, not a sprint, and so you're going to need to figure it out along the way, but just make sure to keep your eyes open because it might be right in front of you and you just not even realize it. So just as a reference point, we started off this company as an investment platform for private debt. Literally, there was no Bloomberg, there was no private capital markets, there was no institutional. It was just that because we knew we could have something there that would be unique and differentiated. And then we brought on the entire institutional puzzle as our investors pushed us to think bigger, as we started to see the gaps in the market, and just be opportunistic and a little bit of luck. But yeah.
Yeah, no, I think that makes sense. I mean, I think, at least personally for me, I think what's super important is being emotionally and psychologically flexible, not
Yeah.
be wed to certain things because, the world's changing. It seems so quickly.
Yeah.
And,
Especially now.
exactly. And to your point with your product market fit, you might stumble onto something that you never considered before.
Yep.
Next question is how important do you feel press coverage is for an early stage startup? Do you feel press coverage helped you in gaining traction, finding customers, and scaling? What was your strategy for getting press?
Yeah, so I will say this differs for different companies for sure. So if you're in the like e-commerce, direct to consumer, like market type side of things, you're going to need press. You're going to need a lot of press basically to be able to drum that up. So that one, you just need to have a better design, a more interesting product, like to be able to actually sell. But in our instance, we didn't really need any press at all at the outset. And I don't think it's that important for a ton of companies. I would say never hire a PR agency early on, because they're not going to do anything for you. It's actually, until you can hit 20 grand in monthly spend, it's not going to get you the returns that you want. And they're just going to be shooting in the dark, and they don't really care about you because you're not spending enough money with them. So you got to do DIY basically. I think the ability to be incredibly smart on how you do digital marketing is way more important, because you have the ability to test things very quickly in that instance. You can test copy that works, you can test various different strategies that work, which audiences work. And so that is going to be way more effective in getting traction and finding customers, because you can start to iterate very rapidly on that, and you're not dependent upon some reporter who is probably going to cover you incorrectly. Mostly at the early stages, if they're covering someone that's really small, they really don't care much at the end of the day. And so I would say focus on what you have control over, and then you can worry about the rest later. There's things that you can do to help get coverage at the very least. You can do guest posting, you can do podcasts. And I think nowadays with the rise of podcasts, actually, I will say, unless you're naturally good at it, your first couple are going to suck pretty terribly. So you can do it with small guys who just aren't even, that don't have a huge audience, and they're trying to get their feet wet too, and they're trying to build up their audience. And so they will take flyers from anybody. And so just reach out, because you never know who's going to be a hit. But in terms of the actual traditional reporting, like Forbes, Bloomberg, those guys, it's going to take a while. And you don't need that to be successful by any means. But when you have reached a certain point, that becomes critical, because that becomes validation, right? So if customers will feel more comfortable putting money with you or buying whatever you're selling because it was validated by a big publication. But the early stage guys, like those tend to be the people that don't really care about that anyway, and they're willing to try things out.
That makes sense. And I guess a question I had is, do you feel that Twitter is important?
Oh boy,
Or
you're talking to
posting on Twitter frequently, or being engaged on
yeah.
Twitter? Or do you feel
So
LinkedIn?
you're
Do you feel LinkedIn is more important, for example?
you're talking to the least social guy out there.
Yeah.
I don't have any presence on social outside of LinkedIn. So I think LinkedIn is not real. It's becoming like professional Facebook, which is not a good spot for LinkedIn to be in. And so I think it leads to engagement. I think it helps you look bigger than you are. And so if you post pretty regularly on LinkedIn, if you build up a following on LinkedIn, like I accept everyone who follows me or tries to connect me on LinkedIn, just because they end up liking our stuff, and then it gets circulated around, it gets bigger and bigger. And so that actually is helpful. But from an actual like engagement perspective on LinkedIn, not that great. I am terrible on Twitter, and I don't exist on Twitter. But I would say that I've heard and seen many success stories where Twitter has led to getting investment from a VC, has led to engaging with customers better. And I mean, obviously, the reverse too also can happen. You can blow up yourself on Twitter too, by saying something very stupid to a customer or to a VC. So don't do that. But it's, yeah, I think Twitter is a pretty successful medium, all things considered. And I would encourage people to use it. I don't listen to my own advice, so I'm terrible at it. But
well, even from the even from the company perspective, do you guys post regularly on your
We
Twitter
do,
or like
yeah. So
X?
we do post regularly on Twitter, and I'll be first to say we need to do a better job of engaging with users on Twitter that
Mm.
comment and like and things like that. But we are not staffed properly to be able
No,
to actually. There's other priorities right now.
that makes sense.
So yeah, but it depends on the company. Some companies need it a lot more. So like we are targeting an older demographic, probably in the mid 30s, 40s, sometimes 50s, and so they are generally less engaged on Twitter anyway. As at the end of the day, so yeah, it depends on the audience.
Yeah, that makes sense. Um, Justin asks, how are your tokens constructed? Are you using existing ERC standards, or did you build your tokens directly based on your own product's needs?
Yeah, good question. So we are just using regular ERC20 tokens, and so they are representative of the actual underlying paper contract, right? So legally today, you can't replace the paper contract. Like the SEC will not allow you to do that. And so what we can do at the very least is show that this deal with this, identifier, like each deal is like 1A, 1B, 2A, 2B. This deal is associated with these people. And so we create wallet addresses for every single investor when they sign up. And then any investment they make is going to have a security that gets put into their wallet, right? The next phase of that is going to be to mirror the cash. And so when they put in 25 grand, we'll mint 25,000 of our stable coin, and then kind of float in there. And then when they make an investment into, 2A, for example, we'll swap 15 grand of 2A securities to the wallet, and then we'll swap 15K of stablecoin to the originator, and then they can take cash and leave the system. So it's more transparent. So we're building on that front, but it's strictly ERC20, nothing too crazy here for now. But we're agnostic. We can go anywhere we want. It just needs to have actual market validation and actual use case for what we're doing.
Cool. So that does it for all the questions that we have. So Nelson, super grateful to have you come on. I'm sure it's been super enlightening to a lot of our founders. So thank you. Also, we have some mentors and others in the crowd. So I was wondering if you have any asks or anything that we can help you out with.
I think, wow, that's question threw me for a curve. I think for now I'm good.
Okay.
But I would say there's definitely opportunities. I'm happy to help you guys out and SOC out however much I can. And so if there's anything that I can do in the future beyond just this, just let me know. I'm always around.
Yeah,
So yeah.
Of course. And I believe the website is cadence.io.
With cadence.io. Yeah.
With cadence.io. You guys can visit it. One of our mentors actually commented that your website's beautifully designed. So,
oh, thank you. There's another version coming soon enough.
Okay.
There's always more that you want to do on technology front that you can't seem to squeeze in time because there's so many other priorities. So yeah, but thank you, appreciate that. And yeah, would love to get people's feedback. And you can always, if you have any questions coming out of this, you can feel free to email me. It's just nelson@withcadence.io. Happy to chat with you. So yeah.
Great. Well, thank you very much. Stay strong in New York City. And
I'm guessing you left.
I did leave. Yeah, I came out for Mother's Day to visit my mother, and I've stayed. When I'll be coming back to the city, TBD.
Good call.
Yeah.
Well, when we do get back, would be great to catch up again. So,
of course. Yeah, would be happy to. Thank you very much.
Awesome. Thanks, everybody. Take care.